The AI and cloud computing king reported their Q2 earnings after the bell. We'll get into everything that we've got going on over at Microsoft. Also, during the conference call, thing you have to understand about Microsoft is they announce their earnings just after the bell, like most companies do, or at least most NASDAQ-listed companies do. But they wait until about 3 o'clock Pacific time to announce their Q3 guidance on the conference call, and they give it to you for all their different business segments. And then you have to add that up and compare it to where Wall Street was. That is when you actually see the most movement in shares of Microsoft, as during the regular trade, shares were roughly flat. Early in the after hours, shares of Microsoft were down. We are seeing, at least in the initial period after announcing their guidance, shares of Microsoft actually moving to a gain. We'll move through all the different business segments as well. Take a look at your Azure and cloud. They are chewing up some market share here, up 30% year over year. We'll go through the different segments, and then we'll come over and look at these financials, which are just absolutely fantastic when you've got $62 billion in revenue and $42 billion in gross margin. This is not for 10 years. This is for 3 months, essentially. You got to absolutely buckle up. It's going to be fantastic. Now, 17.7% growth year over year on those Q2 earnings, which came in at $62 billion and some change. They beat expectations by about $890 million. Those expectations were for 61.3. The high end was for 62.1. So they came just underneath the high end expectations, at least for quarterly revenue. We'll get to profit and operating income here in a second. Talk about Q3 guidance. For all the different business segments that the company operates under, your total revenue guidance coming in right about $60 to $61 billion. That's the guidance Microsoft is giving. Wall Street was expecting just under $61 billion. The high end was for 62.6. The low end was basically 60 billion. So Microsoft meeting the target Wall Street hit, at least as it relates to guidance. That could be a good thing or a bad thing, depending on where you stand with Microsoft, which again has seen its shares just over the last year rally over 68%. Now, the company's different business segments are absolutely humming along, particularly the aforementioned Azure cloud business. Sure be interesting to see Amazon's results. I believe those are either tomorrow or Thursday. Those will be interesting to see if those can meet those results. Obviously, we saw Google struggling a little bit on that cloud growth, basically because most of the business looks like it's moving over to Microsoft, and my guess is Amazon is going to gobble up a fair share of that as well. You saw your Xbox content and services absolutely explode. That is because this is, I believe, the first full quarter where you had Activision bloated onto the company's financials. So some of this revenue impacted by the fact the company completed their $69 billion Activision Blizzard detail. But what they did notice on the conference call is actually that acquisition did hurt the earnings per share just a little bit. So from a revenue perspective, you are getting a boost, but from actual earnings, nothing quite yet, at least from Activision. Now, the company produced that $62 billion worth of revenue in the most recent quarter, 17.7% growth. You're expecting similar type revenue in the upcoming quarter as well, and we're probably expecting similar types of cost of revenue and your gross margins. Look at this, folks. To produce $62 million worth of revenue, your cost on that revenue, this is what's great about a software business, went from 5.7 up to, we'll call that 6. So it barely moved. To add on nearly $9.3 billion worth of revenue, you barely had to add any cost there. Now, you have some service and other costs as well. This company actually reduced their headcount, I think, year over year by about 2%. I would actually expect that to continue to fall as they integrate that Activision Blizzard employees and acquisition into the company. Your gross margins off of $62 billion are $42 billion. That leaves plenty for research and development, which went from 6.8 up to 7.1. Your sales and marketing, 5.7 up to 6.2. These are in billions. Your general administrative, look at this. You love this, guys. 2.4 down to under $2 billion. So they actually drove down G&A costs. And this is where you can drive most of the cost out of a business. If you're looking for cost cutting, look, I want the company to have sales, so I don't mind sales expenses going up. You want the company to invest for the future. That's your R&D spend. Where you can really cut cost is G&A, and that's where the company did. Again, from 2.4 down to 1.9, or we'll call it 2. Your operating income went from 20.4 all the way up to $27 billion. You bolted on $6.7 billion of operating income off of a shade over $9 billion worth of revenue. So when you're bolting on revenue to that top line at Microsoft, a lot of it flows all the way down to operating income. You come all the way down to net income. You went from 16.5 up to $22 billion worth of net income, looking very Google-like, if I were to say. From a balance sheet perspective, company has $81 billion in cash. They shaved some cash off of last year as they completed that $69 billion worth of acquisitions from Activision Blizzard. Now, what I did notice is they took on some short-term debt probably to pay for that. So you have this $27 billion of short-term debt kind of hanging out here. Long-term debt staying relatively flat year over year. Come down to a cash flow statement, pull down that $22 billion in net income as compared to about 16.5 last year. All your additions, subtractions, you went from 11 to all the way up to 18.9 billion on that cash flow. And then it's actually coming in a little light than it was the previous quarter, since you got $49 billion for the first two fiscal quarters for Microsoft. So what are they going to spend this $18 billion on? Some of it getting put into property, plant, and equipment. You're seeing a large boost here as they build out their AI. They're buying those NVIDIA chips. They're building those data centers from 6.3 all the way up to 9.7 on the property, plant, and equipment side. And here's your Activision Blizzard deal, $65 billion in straight cash. Here's your $71 billion primarily property, plant, and equipment, and that acquisition just in a single quarter. So you have $18.9 billion of income from operations. You have a $65 billion acquisition. Got another $10 billion in property, plant, and equipment. Needless to say, you're going to burn through $63 billion, with $1 billion of cash in a single quarter, but not really overly, like, believe it or not, it's not overly concerning, because for the full year, or at least the first 2 quarters of the fiscal year for Microsoft, you have $49 billion worth of operating cash flows. You got to expect the back half of the year is going to be somewhat similar to that. So you're going to have another 49 come in. And you see here, your property, plant, and equipment, 20, your Activision acquisition combined with maybe a few others, now at 71. So it paints a little bit different story. You look at the first 2 quarters, you've only burned through about $17 billion of cash. And again, this is a company with still about $81 billion in cash left. And you gotta tip your hat to Microsoft. The fact that they were able to get that acquisition by regulators, the corporate attorneys over at Microsoft, probably deserve a bonus, because you look at maybe like Amazon, which couldn't get like a $1.2 billion acquisition of a stupid vacuum maker over the finish line. This company got one of the more dominant video game makers from a revenue and a profit perspective into the company's coffers. Financially, things are looking pretty darn good with Microsoft. For the rest of the year, you're probably going to have a slight curtail of the stock repurchases. Part of that is the fact that shares of Microsoft have just been on a tear, so dollar for dollar, it goes a little less. You do see in the most recent quarter, $4 billion of repurchases compared to $5.5 billion over the last year on the previous quarter. 6 months over 6 months, you went from $11 billion down to $8.8 billion. You're still going to be able to collect those dividends, which will likely see an increase later this year from Microsoft. Now, from a technical perspective, it is straight up in an air, and you've been on this vertical uptrend, which is extraordinarily steep. Don't often see this with you see this in the stock market, but rarely in stocks that have a $3 trillion market cap go on this type of rally from like 220 all the way up to 408, basically in the after hours. Shares of Microsoft are flat. I think these results are good enough. Any natural pullbacks that these shares take particularly if you could get one back to the previous highs. I know that seems like a long way at about 340, 350. That would be interesting as well. What you have to expect, though, at some point is the Microsoft uptrend starts to shallow out at some point, and instead of being this kind of vertical, straight up in the air type thing, it starts to shallow out and looks a little bit more normal. Again, any type of pullback in that scenario should be bought, considering the results, considering the cloud business, and considering the company was able to execute on a big acquisition that most companies have not been able to get across the finish line in this regulatory environment. Folks, that was Microsoft Corporation. Hopefully you enjoyed today's video. We'll be back again later this week and obviously on Friday to recap it all. Until then, good luck with your investments.